All right, let's get started. Good afternoon. My name is Randy Sadler with CIC Services. I'm joined by Sean King. Sean, you want to do a quick sound check, make sure everybody can hear you?
Hey, check. Can you hear me, Randy?
Gotcha. Very good.
Good.
So our webinar today, part of our series this year is the 2020 election, which obviously just happened and is still seems to be up in the air, which we thought it might be. And the outlook for captive insurance in 2021 and beyond. So Sean and I will be dialoguing on this topic today, and we're thrilled to have you join us. Let's dive in. So this is the CIC Services Team. CIC Services is a captive insurance company manager. We're in Knoxville, Tennessee, and you can see we've got a wonderful team that would love to work with you if you want to own your own insurance company, or if you're an advisor to prospective small middle market business owners that might benefit from protecting themselves by owning their own insurance company, which is a powerful strategy. Some quick intros, and then we'll kind of get into the meat of our conversation today. Our guest is Sean King. Sean is an attorney, CPA, founder of our firm, one of our co-founders, a principal, and he's also our in-house counsel. As I mentioned, Sean is from Knoxville, Tennessee, just like I am. He got his law degree and accounting degree at University of Tennessee. Go Volunteers. He currently resides in Puerto Rico, and he's been working in the captive insurance industry since 2005. So quite a run for Sean as well. And he's quite an expert in the industry. Many of you probably have seen some of his writings, whether it's about court cases or whether it's addressing our current court case against the IRS that to be heard by the Supreme Court this December. So we're very excited about that. And then here's my bio. I'm Randy Sadler. As I mentioned, I'm from Knoxville, Tennessee also. And I always tell everybody that I went to the United States Military Academy at West Point, and then I was a tank commander 5 years. And really, I learned risk management in the Army, where I had responsibility for, at one time, 150 wheeled and tracked vehicles, 300 soldiers, had to make sure that everybody was safe, with food, fuel, ammunition, and the like. And so that's really where I learned risk management. Have tracked through some corporations on my way to CIC Services. I've been here 8 years. I've become a principal in the firm. And since I've been here, we've tripled. So it's been really wonderful being part of CIC Services. Sean, if you would, tell us, since you helped found the company, tell us a little bit more about CIC Services so everybody get a feel for the company.
Sure. CIC Services is what's known in our industry as a captive manager. Most every state or jurisdiction that licenses captive insurance companies requires those captive insurance companies to engage the services of a captive manager like our firm. You can think of a captive manager kind of like a TPA firm. So what a TPA firm is to a 401k plan or a health insurance plan, we are kind of like that to a captive insurance company. So we help our clients form and operate captive insurance companies, and we kind of serve as the center of the wheel to which all the various spokes connect. And so we try to offer our clients as much of a turnkey feel as we possibly can by coordinating the efforts of all the other parties involved in managing a captive, which includes the actuaries, underwriters, risk assessors, claims adjusters, captive attorney, CPAs, etc.
Perfect. So tell us a little more, Sean. What does CIC Services help businesses do?
Well, essentially, we help them own and operate their own insurance company. There are a number of incredible advantages that businesses can obtain from that. One is they can establish asset protected reserves. Right now, we'll see this on a future slide here in just a few minutes. Businesses, or many businesses, are sitting on massive amounts of cash reserves, massive amounts of liquidity as a hedge against uncertainty. And right now, all of that liquidity, all of that hedge is exposed to potentially creditors of the business if something goes wrong, and also potentially taxes. And through a captive insurance company, we can help protect some of those contingency reserves from creditors in an asset protected way. We also help businesses increase their profit, reduce their overall cost of insurance, and help generate wealth. Lower and control their insurance costs, ensure uninsured or underinsured risks. And a lot of these risks seemed somewhat theoretical until 2020. And a great many businesses figured out the hard way that some of these risks that we've been talking about now for 15 years are very real indeed. And we'll talk more about what some of those are in a minute. And then finally is benefiting from some potential tax advantages. You know, Congress recognizes that small and mid-market businesses in particular are both essential to our nation's economy and uniquely fragile compared to Fortune 1000 companies. And it provides a tax incentive or a tax inducement for businesses who may want to set up and operate a real legitimate insurance company to help make them more robust and less susceptible to some of the risks that we'll be talking about here in just a few minutes.
So today's agenda is, first of all, what is a captive insurance company? It's always important to cover the fundamentals. And we're also, as many of you know, and I often get emails and calls about, we're in our 60-day countdown. We do a 60-day countdown every year. And so people ask me, what's the significance of the countdown? Or I think it's really cool that you do it, especially some of our captivating thinking readers. So we'll talk a little bit about the countdown, just as a reminder because of the time of year, and then we're going to dig into the 2020 election and the outlook for captive insurance in 2021 and beyond. So, Sean, tell us, what is a captive insurance company?
Essentially, a captive insurance company is just a closely held insurance company. So just like you and your clients have probably done many times, you've formed a corporation or formed an LLC. You do the same thing here. Your clients would go out, form a new corporation, form an LLC, except this particular one would take an additional step. It would take the step of getting licensed by a domicile, a U.S. state typically, or in some instances, a foreign jurisdiction, to operate as an actual insurance company, not merely as an insurance agent or broker, but as an actual company that will issue policies, insure risks, assume risks, and pay claims as they happen. So it's a closely held insurance company formed primarily for the purpose of insuring risks of a related business, which is why it's called a captive insurance company. Its interests are somewhat captive to those of its primary insureds. They've been around for a long time. They've really been around in the U.S. at least since the 1950s, and in other parts of the world for longer than that. And they can be used to accomplish a number of different business objectives.
Very good. Yeah, I always tell people when I talk about captive insurance that the word captive does sound bad. It might be better to think of it as like a tethered insurance company, tethered to your business and your operation. But whoever invented it coined the term captive, so we're stuck with it. Very good. So let's go to the next slide. As we think about captives and what they do, Sean, what are some of the things that the captive can do, especially in the middle market?
Yeah, the middle market, small and mid-market businesses especially, as I said before, are uniquely fragile. Unlike a Fortune 1000 company, they can't just issue more stock or float some more bonds when they have an unexpected contingency happen or they run into cash flow difficulties. And so through a captive insurance company, they can become much more robust. And they can do that by, for example, replacing insurance that they're currently buying from a commercial carrier with insurance that they instead buy from their own captive insurance company. And that captive insurance company can reinsure some of those risks to other unrelated parties also. So by replacing commercial insurance with captive insurance, we can often reduce overall insurance costs, often lower premiums. And if the business operates well and keeps claims low, which it now has every incentive to do, since the related captive is insuring some of those risks, we can improve the profitability and the loss history of the business as a whole. We can use captives to also insure what we call enterprise risks. We'll talk much more about that in a minute, but basically these are various risks that are embedded in a given business model that are presently often uninsured or significantly underinsured. They can be used to insure warranties, to issue performance bonds, so to provide bonding, for example. They can be used for employee benefits and healthcare. A number of other things, and any combination of those things. So very flexible tools that can be used to solve a number of important business challenges.
Yeah, very good point. That any combination of the above is particularly powerful in the middle market, where a smaller mid-sized company can't afford to run 3 or 4 captives, but one captive could insure some commercial risk, pick up some enterprise risk, even maybe take a slice of their health insurance, saving 15 to 20% on healthcare costs. And so essentially able to use that captive insurance company like a Swiss Army knife. So very, very powerful tool. So Sean, tell us a little bit about your typical captive insurance structure and how we should think about it.
Yeah, this will be, I think, one of the final slides, just talking about captives in general. We just want to make sure everybody's on the same page about what a captive is and how they work. And then we'll move into talking more about sort of the election and the impact of the election on small businesses, captive insurance companies, et cetera. But yeah, this shows sort of a common structure. This shows what's called a brother-sister relationship. So you have the business, the main operating business over on the left. This could be a construction company, it could be an environmental cleanup firm, it could be a physician's practice, it could be really any sort of business that's profitable and spinning off free cash flow. And then you have over on the right-hand side of the page, the captive insurance company. And typically there's common ownership among the business on the left and the captive on the right. So they typically will share a common set of shareholders. They're not always identical shareholders, but usually significant amount of overlap. And the business on the left then will issue or pay, I should say, premiums and transfer risk over to the captive insurance company on the right. We'll talk again more about what some of those policies might look like in a second. And the captive insurance company, in exchange for those premiums, transfers to the business a policy, an insurance policy that defines the risks that are insured and specifies the conditions under which the captive insurance company will reimburse the insured business for those risks. So that's the basic structure. We can also set these up in a parent-subsidiary relationship, though in the small and mid-market business world anyway, that's a much less common structure than the brother-sister relationship that you're seeing here. And then if we go to the next slide, the captive insurance company on the right really can be a separate profit center, and it can, in fact, reinsure some of the risks that it assumes out to unrelated third-party captive insurance companies or other types of reinsurance companies, so that when the business on the far left has a claim, a portion of that claim gets actually borne by unrelated parties, captives that aren't associated with that business directly in any way. So it is, or can be at least, a very real, legitimate sort of insurance structure with real risk shifting, real risk distribution, and real sharing of risk among the various captives that participate in the arrangement.
Yeah, very good points. One thing I like to emphasize too, because very often when we're working with small and middle market companies, very often their CPA or their property casualty insurance agent or their wealth manager often is like their CFO. In other words, they may have finance staff that do all the work inside the company, but really don't provide financial strategies, right? So think about what Sean said. This captive insurance company can become like a profit center. Not only is it protecting the business, even getting reinsurance or pooling with other captives to provide a kind of a co-op insurance arrangement, but as it builds profit, that creates assets under management, right? So that creates a whole new financial strategy for the captive. So very powerful there. Okay. And these are some of the standard captive insurance company benefits. And we won't really go through these today, but if you'd like the slides, we'll send them to you. But you can see there's just a lot of benefits to owning your own insurance company. And really what a captive does is provide more insurance and more money, more insurance and more money. Think about having both those at the same time and the power of that, especially as we start thinking about the election and uncertainty, which Sean alluded to already. So Sean, every year we do the 60-day countdown. We're now at day 26. So we definitely, we get so many questions about the countdown, why we do it. Give us a quick overview on why we do the countdown every year.
Yeah, so every year in October and November, we kind of really promote heavily the benefits of captives. And we do it that time of year primarily because this is the time of year we've gotten into the fourth quarter. Most businesses have a feel for how the current year is turning out. They begin to look forward into the next upcoming year, and they begin to plan. And they may, in fact, many of them decide they may want a captive insurance arrangement to be in place for all of the next fiscal year. And if they're going to do that, then they really need to act in October and November. You can maybe get into early December. But the fact of the matter is it takes time to really properly form a legitimate captive insurance company. There's a risk assessment process that's got to go on. There's underwritings and feasibility study. The actuaries have to take the feasibility study and use it to develop pricing. The captive attorney has to form the company. We have to work with the regulators to get it licensed in the jurisdiction of choice. It's got to be capitalized, and then finally premiums paid, policies issued, and the peace of mind that comes from the arrangement. And all of that's got to be done in many cases before January 1 if they're wanting to have coverage for the entirety of the following year. So not that you can't form a captive in January or February or March, you certainly can. But this is just the perfect time of year when business owners are approaching the holidays. They get a little sentimental about what's happened over the prior year. They start looking forward to the future. And this is the time to plan for a captive insurance company for next year.
Yeah, exactly. So the significance of the countdown, if a business owner has a successful business or businesses, think about it like laying golden eggs, right? This time of year, of course, October is already gone. Business owners start assessing how to allocate those golden eggs, perhaps capital expenditures, dividends, owner profits. And then, as Sean and I often talk about, the obvious, most logical choice, to protect the goose, right? So you ought to take some of those eggs, protect the goose that lays those golden eggs for the business. And this year is no different. And the election certainly causes us to ponder the importance of protecting that goose, regardless of who wins. So remember that owning an insurance company, protecting the goose can result in both more insurance and more money. So now we get to really the thrust of today's webinar, the 2020 election and the outlook for captive insurance in 2021 and beyond. Sean, one of the questions that's on everybody's mind is always with captives, the IRS. Will the election affect the IRS and captives?
Yeah, great question. Likely not, right? The IRS has been hostile toward captive insurance companies going back at least to the 1970s. They have fairly aggressively and at various points in time ever since then scrutinized captives, attacked captives, litigated captives. That's the bad news. The good news is that over that period of time, they have lost literally almost every single court case of consequence involving captive insurance companies. They lost the Humana case, they lost the UPS case, the Rent-A-Center case, the Securitas case, the RVI case. And so despite the fact that captives and the IRS has been hostile toward captives for decades, captives have continued to grow and to expand and become increasingly important within our nation's economy because they provide very important insurance that's needed by small and mid-market businesses, and they can't get it elsewhere. So I don't think we can count on sort of the IRS's view of the world to change. I mean, eventually it will, but I don't think it will happen as a result of the election. More likely it will just happen over time as additional court cases prove to the IRS, and more importantly to taxpayers and their advisors, exactly what a legitimate captive insurance company looks like from a tax perspective. I will say though that a lot of times clients get anxious about the IRS hostility, and it keeps them from doing captive insurance companies. In fact, Randy, you just wrote an amazing article or contributed to an amazing article that was recently published describing a client who unfortunately got their arm twisted by the IRS and shut down their captive insurance company in 2019, only to be nailed by COVID in 2020. And
yeah, they lost $500,000.
$500,000 they would have been able to gain from reinsurance arrangements under their captive insurance company if they still had it in place, and they really regretted shutting it down. So, I don't think we can count on the IRS's view of the world changing. But if you don't, if you are hyper concerned about the tax benefits, just don't claim the tax benefits. You can get all of the other benefits of a captive insurance arrangement, not claim the tax benefits that are arguably or potentially available to you. And then you don't have to worry about IRS scrutiny. IRS scrutiny only comes along if you claim both the ordinary insurance benefits of a captive and you want to claim the extraordinary tax benefits that the code makes available for legitimate captives. And even then, if you do claim those tax benefits and you do operate a legitimate captive, you should probably be prepared for questions at some point in your future from the IRS, 3 years from now, 5 years from now, 10 years from now, who knows? But you should also feel comfortable and confident that you're going to be able to defend the transaction. And we're getting increasing guidance from the tax courts and the like on how to do that every day.
Yeah, very good point, Sean. So, Sean, who likes captives more, Republicans or Democrats, Trump or Biden? I had somebody last week say, Vermont, largely Democrat state, very big in captives. Delaware, very big in captives. North Carolina is now a swing state, very big in captives. Tennessee, very big in captive space. Out west, you've got states like Utah, Montana, Nevada that are actively licensing captives. So who likes captives more? Who's more captive friendly?
Yeah, this is what's so fascinating. I mean, captive insurance companies is one of the very few topics today that actually brings both parties together. Both parties are united in their support of captive insurance companies. In fact, the last time Congress scrutinized captives, which was just a few years ago now, they ended up passing the PATH Act, and they actually expanded the opportunity of captives. They increased the premium limit from 1.2 million per year up to 2.3 million potentially per year for Section 831B electing captives. So Congress is a huge fan. Senator Grassley, a big Republican from Iowa, has been very pro-captive his entire career. Howard Dean, former presidential candidate for the Democrat Party and former governor of Vermont, was instrumental in making Vermont a worldwide hub for captive insurance companies back in the 1990s, and it remains so to this day. So captives are fortunately one of those few items today that seems to unite both parties together. If only the IRS could likewise catch a clue. It would be green pastures, and it's still, I think, green pastures. It's just green pastures that you got to be aware of and pay attention to as you enter those pastures.
Right, you gotta get around a few pitfalls to get into the pastures, right? That's right.
Exactly.
Now, Sean, what would the impact? I mean, it would appear that Biden is going to win, though we don't know that for sure. What would the impact of a Biden presidency be on captives and let's say the courts? I mean, obviously the president appoints judges. What impact might that have on tax courts and even the Supreme Court?
Yeah, great question. So, again, both parties, and I don't think Biden will be an exception to this, are generally very supportive of captives. Biden would basically, at least if he fulfills his campaign promises, would increase tax rates, right? And so that would, if anything, from a tax perspective, for those captive insurance companies that are legitimate and that do elect to take advantage of the legitimate for federal income tax purposes, I should say, and that do choose to take advantage of the extraordinary tax benefits, the tax incentive would be even greater under a Biden administration, very likely because tax rates would be higher. So in one way, that would make captives more appealing. Another, with regard to the courts, for example, Trump has typically appointed more originalist, sort of conservative judges that are perhaps less, less open-minded to the administrative state, a little more skeptical of administrative state overreach. And the IRS is obviously one of the most important aspects of the administrative state. So in a Biden administration, you'd probably have, clearly more liberal judges. They may be inclined to give a little more deference to the administrative determinations of administrative agencies like the IRS than perhaps, Trump elected judges would. But it's going to take a long while, even if that proves to be true, for that to take place. I mean, Trump really did load up on the appointing federal judges during the last 4 years, and had, of course, 3 Supreme Court appointments over the last 4 years that put the court heavily in the conservatives' hands. So that could always be changed through court packing scenarios and the like. There's a lot of political risk to that. I think that's probably more talk than and more pandering to the base than it is actually likely to happen. But I think that in a nutshell describes the impact that the 2 different parties might have on the courts and the like.
Very good. Yeah. Now, one thing we talked about, obviously, there's still uncertainty around the election, votes being counted, mail-in ballots, allegations on both sides against each other. And so a lot of uncertainty. 2020 with COVID, with civil unrest, the election, even now, uncertainty reigns. And that really brings us to our next slide. Sean, tell us about what uncertainty does, in this case, to investors. We just got this fact sheet, but what does it do to business owners? Yeah, well, what this chart shows, it's fascinating, right? On the far left, if you look where it says money funds, it shows you in a presidential election year and in a non-presidential election year, the typical amount of inflows into money market funds, essentially cash. And you'll see that in a normal presidential year, it's, averages around $115 million or so. If you go over to the right and you look at 2020, you'll see a massive increase in cash, right? Corporations are hoarding cash. Individuals who are fortunate enough to have cash are hoarding cash. We've gone up to nearly $1 trillion in new inflows into money funds during the course of 2020. So that's a huge cash reserve, right? Why are businesses doing that? They are doing that because the future is so uncertain. And in light of that uncertainty, the last thing they want is to get short on cash, right? They want to hold on to the cash they have. They don't want to make aggressive investments at this point in time because the payoff of those is just so uncertain in light of what's going on in the world with the pandemic, with the economy, and a number of other factors. So that is a huge amount of money. A good portion of that is actually being with the small and mid-market business and business owners that we serve. Well, obviously a lot of that's Fortune 1000, but
but there's a lot of small and mid-market businesses that are sitting on extraordinary levels of cash right now. And they're doing it to help manage uncertainty. Well, doing it that way, just keeping cash in your bank account, comes with a lot of problems. Number one, it's not asset protected, right? If something goes wrong in the business's creditors can get to it. Plaintiffs in a lawsuit can potentially get to it. And it's not very tax efficient, right? Just taking your profits, paying taxes on that money, and then setting aside in some reserve for a future contingency is a very tax inefficient way to manage risk. And so what this huge amount of cash really represents, I think, is a massive opportunity to talk about captive insurance with a lot of these businesses. They can form their own captive insurance company. They can use some of this liquid cash to pay premiums over to their related business, their captive, to insure some of these risks that are really keeping them up at night. And at the same time, by doing that, at the end of the day, especially if they decide to claim the income tax benefits, they can end up with both more insurance and more cash, more liquidity due to potentially some of the tax savings. So a massive, massive opportunity here to help people more effectively plan for risk and uncertainty than just sticking a bunch of cash in a checking account and hoping for the best.
Yeah, massive opportunity is definitely an understatement, isn't it? So even our own federal government recognizes that mid-sized businesses have a lot of risks. If you think about the cash that Sean just talked about, this chart from ready.gov outlines, a wide range of threats that small mid-market companies face. We cover this slide often when we do our webinars and presentations. But I think, it's important to note that our federal government recognizes these risks, often not commercially insured, but could be insured via a captive. And today we're going to focus on a very similar chart, common uninsured, underinsured risks, right? The middle box here, or the inside box, is operational risks. These are risks typically inside of a business as it operates. And then strategic risks are existential external risks that businesses face. And we've put some little notes here. Sean and I are going to cover a few of these because as you think about the election results, and they're not final yet, but the impact of the winner of the presidential race and of who governs can drive some of these risks. So, Sean, why don't you dive in, speak to some of the, what are some of the common threats we might see or common risks that might increase as a result of a Democratic administration?
Sure. Well, let's start with a couple of the operational risks, and then I'll talk about a couple of the strategic ones, and then Randy, you feel free to jump in too if you have some thoughts. But one of the most obvious one is administrative actions risk. Administrative actions risk is a risk faced by nearly every business, and it's the risk of some governmental agency at the state, federal, or local level coming in and auditing the business, investigating the business, suspending its license, doing something that costs it a lot of money, either in lost revenue because of a suspended license or something like that, or in additional expenses to defend, say, an investigation, like a Department of Labor investigation or something like that. So administrative actions risk is very real. I'll give just a couple of examples of situations that we've seen or heard about, at least. You guys may all remember the Chipotle incident that took place a couple years ago, where in many locations across the country, they ended up basically having food poisoning. And that was all over the news. And sales at Chipotle restaurants all across the country took a hit. Now, that's actually more an example of a reputational damages risk, and I'll cover that maybe later. But think about a situation like a restaurant that has a liquor license, right? And you're hiring teenage waiters, and some teenage waiter that you've told 1,000 times to be sure to check IDs fails to check ID, and you get your liquor license suspended or revoked. Extremely costly. Most sit-down restaurants can't survive without being able to sell liquor or wine, beer and wine at the very least. So, that's an example of an administrative actions risk. There was the famous incident with Gibson Guitar that you guys may remember from back in the 2000s, where the Environmental Protection Agency just showed up one day and walked off unannounced, no hearing, with basically their entire inventory, alleging that they had imported improperly and illegally rare protected hardwoods from rainforests for use in manufacturing their guitars. And they, of course, denied that. They defended it. They ultimately got their inventory back after weeks of litigation and millions of dollars in legal fees during a time which they had no inventory to sell. So that's an example of administrative action type of risk, and nearly every business is susceptible to that. Another one that I would just mention would be employment practices type of risks. And I should say, by the way, on administrative actions, that's probably a bigger threat under a Democratic administration, or at least a non-Trump administration. Trump really has made an effort to reduce regulations, to reduce the impact of the administrative state, to cut back on aggressive, and in some cases, if you've been a subject of them, unnecessarily aggressive enforcement actions by some of these administrative agencies. That's much less true under a Democratic administration. Just to give one example, under the Obama administration, fines collected by the DOL each year had averaged less than $200 million a year for decades. Obama came in, and by the time President Obama left, they were collecting well over $1 billion a year in fines and penalties just through the DOL alone. So a massive increase in enforcement actions under President Obama, and something that could be potentially happen again under a President Biden. We'll see. Let's see, what's another risk I should maybe pick up on here, Randy?
Yeah, definitely healthcare costs going up is a risk.
Yeah, certainly with a Democratic administration, you could potentially expect with Obamacare staying in place and maybe even being increased, you could potentially see significant increases in healthcare expenditures and a number of other risks like that. If we move up to the strategic risk category, this is an example of things that can go wrong in the world as a whole. So operational risks are things that can go wrong in your business. Strategic risks are things that can go wrong in the world outside of your business that nonetheless can cost your business a ton of money. And one of the most obvious of those at the moment is the pandemic, COVID, right? Because of COVID, you can have loss of key customers. Customers that you have sold to for decades may be bankrupt or on their way to bankruptcy. You may lose key suppliers and have supply chain interruption as there are lockdowns and suspensions in business operations, either in this country or in other countries. We had a number of clients whose supply chain was affected back in February and March, well before things ever got out of control here, because their supply chains extended all the way to Asia, and they were severely impacted from that. So that's an example of some types of risks that would arguably be worse under a President Trump, who has taken more of a hands-off approach in managing the pandemic, sort of allowing the virus to spread more rapidly than perhaps a President Biden would, or perhaps at least as President Biden or candidate Biden has said that he would. Obviously, if you get the pandemic under control, then arguably you would have fewer supply chain interruptions potentially, fewer businesses going bankrupt potentially because of customers who are avoiding the business due to COVID fears and the like. So the big debate, what causes the economic damage? Is it the lockdowns themselves, or is it voluntary actions of individuals and businesses who are trying to avoid getting infected? And I think the answer is both. And so that's going to play out a little differently depending on which party ends up gaining control of the White House and how they end up addressing the pandemic.
Yeah, very good points. As you think about, just to add to what Sean said, we're definitely in a hard insurance market, and that hard insurance market's fueled by several things, but it kind of mirrors the 1980s. And if you remember the 80s, we had tax cuts, we had deregulation, we had economic growth. Of course, now we have the compounding of a pandemic on top of it. But in that hard market, and certainly if Trump is elected, we should expect that hard market to continue. It's hard to say if Biden's policies would fuel even more of a hard market or not, but things like auto liability, work comp, general liability, property, we're seeing more and more interest, even in middle market companies, to insure those in a captive, or at least insure part of it in a captive. So in some cases, we can insure it in a captive. In others, it may be more difficult, but you see even here existing deductibles. So more and more insurance carriers are to taking higher deductibles, if you will, in this hard market. And so, businesses that have good loss controls in place can do things like pick up maybe some work comps and general liability property, and then have the existing deductible coverage. And that allows them to save costs during this very difficult time. I've noted supply chain potentially, with Trump's trade policies. We definitely have clients that their captives have paid due to cost increases caused by tariffs, for example. So their claims were approved and paid. So that's definitely something to consider, that would likely continue as well. You can see, depending on which way the election wins finally end up landing, that a captive can be very powerful as long as it's strategically used either way. Sean, tell us a little bit about, more insurance, more money, as we think about the election uncertainty heading into 21 and beyond. How should businesses be thinking about the future?
Well, I think that's, the biggest lesson of this is sort of the lesson of the black swan, right? It's so many business owners are head down, focused on their business, on their day-to-day operations, on dealing with the problem of the moment. Very few take the time to step back and really do a thorough, comprehensive risk assessment, to really look at their business model, to figure out what all of their various risk exposures are, to figure out which ones of those they're already insured against through their commercial policies, and which ones they're going presently naked on or have no real contingency plan to manage. So the most important thing that COVID brought home, I think, is, for business owners at least, the importance of stepping back occasionally. And I think now, this time of year, is the perfect time to do it, and really reflect on one's business model, upon the various risks that one has, and figure out what's the best way of dealing with it. And captive insurance is going to be, in many instances, the best or one of the best ways of managing a lot of these risks, for the simple reason that it's the only way that we know of to potentially have more insurance and more money. Normally, getting more insurance means you have less money, right? But with captive insurance, and especially if it's a legitimate insurance company that chooses to take advantage of the extraordinary tax benefits, you can end up having, at the end of the day, both more insurance covering your business and more liquid reserves. How does that work? Well, the little chart here shows you. We're assuming here we have two businesses. Business on the left is your typical business who just buys the basic forms of insurance that every business owner buys because the law requires it, or because their lender requires it, or because it's just obvious. And that's things like auto liability, employment practices, general liability, umbrella, workers' comp, et cetera. But we're assuming, and then the business on the right is a business that has formed their own captive insurance company. And in addition to buying all of those sort of risks that the business on the left did, buys all of the insurers through the captive, all of the various risks that you also see listed in green. Now, we're assuming that each of these businesses has about $1 million a year in free cash flow. The business on the left would take that $1 million a year of free cash flow, of profits, pay taxes on it, And at the end of 10 years, assuming it retained those monies as a contingency reserve, would have about 5.9 million in reserves and would have only the most basic sort of risks insured. By contrast, the business on the right, in this example, takes that $1 million a year of free cash flow and pays it in the form of premiums to insure all the various risks there that you see listed in green. And in doing so, again, assuming that it's a legitimate insurance company and it chooses to take advantage of the extraordinary tax benefits, it ends up having not just more insurance, but also potentially double the amount of reserves, or nearly double the amount of reserves, 10.7 million versus within the captive versus 5.9 million in a contingency fund within the operating business. That 10.7 million in the captive is largely asset protected. The 5.79 million on the left in the operating business is not. So once again, captive insurance is really the only way we know of to potentially end up with both more insurance and more money at the end of the day.
Absolutely. So the outlook for 2021 and beyond is to protect the goose that lays the golden eggs, right? That's really what businesses need to be doing regardless of who wins the election. So this concludes our webinar today. If you've got any questions, definitely feel free. Sean and I will hang around. You can unmute and ask your question, or you can type it into the chat bar. If you'd like a copy of the slides, send either Sean or me an email, and we'll be glad to get those to you. We also did record this webinar, and it'll be posted on our website probably in the next 3 to 4 days. So what questions do y'all have? Don't be shy. If there's something on your mind, type it in the chat bar or feel free to unmute and ask. All right, very good. Well, we hope that you all have a wonderful rest of the day, a wonderful rest of 2020. If there's any way that we can support you, please let us know. Oh, I see a chat. We got a question, 2 questions. Everybody was reaching for it fast. Okay. Sean, you're still there, aren't you?
I am.
Okay, so we have a couple questions. Are there any unusual gap treatments?
Gap accounting?
Yeah, GAAP, yeah. I think it.
Yeah, generally accepted accounting principles, yeah.
Yeah.
So good question. You know, that's a really good question, and I don't know the answer to it. Most of our businesses aren't keeping their books and records, you know, using GAAP accounting. Most of our clients aren't. Some of them surely are. And I know that issue has come up in numerous instances. But generally, my understanding is that if it's a brother-sister sort of control structure, rather than, say, a parent subsidiary, then there really aren't any unusual GAAP sort of accounting. It's going to be typically accounted for as most any other insurance premium would be, both on the premium payer's side, the insured entity side, and the captive insurance company's side. So something that would be, we definitely want to run that by the auditing CPA or the CPA that is preparing the financials for the captive. But in general, there's nothing unusually difficult or challenging or strange about the accounting for these captive insurance companies.
Okay. Very good. And I just got a question about, will this be video? Yes, we are recording this session. It will be posted on our website. If you definitely want to make sure you get it right away, send me an email or send Sean an email. And as soon as the link's up, we'll send it to you. Very good. Any other questions? Thank you so much for joining us today. Again, have a wonderful after. Oh, we got another question. There it is. Okay. Let's see. Have you seen increased IRS audit activity on captives?
Over the last, probably 10 years, we have. Most all of that activity was prior to 2016. Once the Notice 2016-66 came out and taxpayers were required to affirmatively disclose to the IRS their participation in any captive insurance arrangements that did choose to take advantage of the extraordinary tax benefits, the audit activity really dropped off. So we did not see hardly any audits for really the 4 years from late 2016 when that notice came out up until recently. Now, very recently, the IRS has announced that they are sort of starting an audit sweep of the captive insurance industry. This is somewhat similar to a sweep they conducted of the 403B industry many years ago. And the idea here is they're going to be auditing presumably a fair number of folks who do engage in captive insurance transactions and who have chosen to take advantage of those extraordinary tax benefits. We certainly hope that the result of those audits is eventually, as happened in the 403B space, some guidance from the IRS. You know, everybody that we're involved with who forms a captive insurance company is interested in doing this right. Nobody is interested in playing games. Nobody is interested in claiming benefits they're not entitled to or gaming the system. And so, you know, the IRS can clear up really any uncertainty in the captive space that it wants to simply by offering taxpayers guidance that they would certainly, almost certainly follow in nearly every instance. So, you know, the bad news is there are some of these audits, and you need to be aware that that is a possibility. You know, the good news is that we've generally had favorable audit experience. We've had several clients be audited where their transactions, or their audits, I should say, closed with no changes. And we've had some instances where the IRS did challenge the captive because the IRS believed the client had formed the captive for, you know, improper purposes. I think one of the most important aspects of this is if you're having a conversation about captive insurance, it needs to be, as we have today, really focused on risk management. If the pitch to do the captive insurance transaction is all about tax savings, tax savings, tax savings, tax savings, that's really going to irritate the IRS in an audit if that gets discovered. So if you are having conversations about a captive and with potential prospective clients about a captive, just make sure that it's approached first and foremost from a risk management perspective, as we have done here in our conversation today.
Very good points, Sean. We do have another question. Do we like Bermuda as a captive license location? I'll take a quick pass. We actually don't do any work with Bermuda today, so we really can't comment on working with them. What I would tell you is when we think about a captive license location, or what we call a domicile, I always like to think about it as Goldilocks and the Three Bears, right? So, you know, Papa Bear was too tough. There are some domiciles that regulate very strictly and create a lot of red tape and paperwork. It's largely because they're used to working with Fortune 1000s, and they can have their lawyers talk to your lawyers, you know, and create all this red tape, and they're used to red tape, and that's just not a fit for most middle market companies. On the flip side, though, there are domiciles that regulate too loosely, kind of like Mama Bear's too soft, and so when a regulator's too loose, they don't take a hard look at your work, make sure the actuary pricing makes sense, make sure the insurance policies are drafted well, you know, take a hard look at risk sharing or distribution, and really do their homework as a regulator to regulate the insurance company. So an unregulated insurance company or poorly regulated insurance company can often get itself in trouble. And so it's really good to have a regulator who's making sure that the insurance company is running well. And for U.S.-based domiciles, we definitely like Tennessee, North Carolina, Connecticut, Delaware. Those are ones that we do have quite a bit of experience with, and we're definitely positive on all of them. And so when you think about domiciles, think about Baby Bear. You want a domicile that's just right for your program. Any other questions? All right. Well, it's been great having everybody with us today. Have a great rest of the day, a great rest of 2020. If we can help you in any way, we'd be honored to work with you. All right. Goodbye.